I'm Mike, here with my fellow market analyst, Susan.
Good morning.
Welcome, everyone, to vpod.ai. You can sponsor this podcast for just $25. Your message will be featured across major platforms like Apple Podcasts, Amazon Music, Spotify, and more. If you're interested, contact info@vpod.ai to get started today. So today, our mission is to cut through some of the noise around the latest corporate earnings from America's biggest home improvement retailer.
Right.
Because these numbers, they aren't just about retail. They're a real pulse check on the U.S. consumer, especially the middle class, and, well, the deep freeze we're seeing in the housing market.
That's exactly right. This company is a crucial bellwether. It tells us so much about discretionary spending, about investment in the home. And this latest report for Q3 2025 gave us a classic split decision.
A mixed bag.
A total mixed bag. They beat on revenue, which on its face signals strength, but then they fundamentally missed on earnings per share. And that immediately created volatility and forced them to revise their guidance for the future.
So it tells a story of a business that's growing, but maybe not in a profitable way.
It's growing, but it's fighting this intense battle against cost and, caution.
Okay, so let's dig into that paradox. The revenue part, at first glance, it looked pretty strong. They reported $41.4 billion.
Yep, which cleared the analyst forecast of $41.18 billion. That's a 2.8% increase year over year. Not bad at all.
So the cash register is definitely ringing.
The cash register is ringing, yes, but the profit that's left over is shrinking, and that's the crux of the investor concern.
Right.
Their adjusted diluted earnings per share, or EPS, it came in at $3.74. The expectation was $3.84. So when a huge company like this can't convert more sales into the profit you expect, it just flashes warning signs about margin pressure.
And we saw that pressure directly in the operating margin number, didn't we? It dipped to 12.9%.
Down from 13.5% just last year.
And just to be clear, operating margin is basically how efficiently they're running the business, right? After all the costs.
Exactly. A half-point drop like that suggests costs are rising, or maybe there are supply chain issues, or it could be a shift in what people are buying, a move toward lower margin products.
Or all of the above.
It's likely a combination of all three. And the market, well, it did not hesitate. Despite that revenue beat, the stock immediately sold off, 5.44% in pre-market trading?
No.
That move tells you exactly what investors are focused on. The profit miss and the shrinking margin, they just outweighed everything else.
So that structural pressure on profit, it leads us right to the headwinds. If margins are getting squeezed, we have to ask why. What's cooling demand for the high profit stuff?
Well, the executive commentary was pretty direct. They pointed to two big macroeconomic factors. First, quote, consumer uncertainty, and second, continued pressure in housing.
The housing piece feels like the big one.
Oh, it's foundational for this industry. They had been banking on a recovery in the second half of the year, fueled by rate cuts.
That never came.
That never materialized, so it just left them exposed to a very, very cautious consumer.
And we know what high interest rates and home prices have done. They've just slammed the brakes on people moving.
Precisely. Housing activity is running at near 40-year lows. We're talking about a turnover rate of only about 2.9% of the housing stock.
And when people don't move, they don't do those huge, expensive renovations that a new home triggers.
Exactly. You move into a new house, you immediately think, I've got to redo the kitchen, or let's fix the floors. When you stay put, those projects get pushed off indefinitely.
We can actually see that deferral in their sales data.
Yep.
The number of comparable transactions, so just the number of times people bought something, that was down 1.6%.
And they were explicit about it. Customers are delaying, quote, larger discretionary projects where customers typically use financing.
So kitchen and bathroom remodels, the big stuff.
The big stuff. Now, there's a nuance here, which is interesting.
Right.
Big ticket transactions. So anything over $1,000, they were actually up 2.3%.
Okay, so how does that work?
Well, the company clarified that this wasn't the average DIYer finally doing that kitchen. It was mostly from higher-priced innovative items like smart appliances and critically continued strength with their professional contractor customers.
Ah, the pros.
The pros. They're just less sensitive to those interest rate swings for their project financing.
So the DIY customer pulls back, the pro holds steady. But there was another factor here, something nobody can control. The weather.
Yes, the absence of storms. It sounds like a bit of an excuse, but for a retailer that sells huge amounts of roofing, generators, and plywood, it's a massive factor.
Right. Storm prep and recovery.
Exactly. The executives pointed to that lack of storm activity as the main reason sales actually turned negative in October. A major hurricane or storm system drives a ton of emergency high-margin business, and that just didn't happen.
That's fascinating. But it also comes back to this bigger idea of the K-shaped consumer, doesn't it? Even if this retailer serves a more affluent base, you can still see signs of middle-class fatigue.
The data strongly suggests that bifurcation. High-income households are still resilient, they're still spending. But for the lower end of their customer base, that middle-class consumer, inflation has created real exhaustion.
People are just having to make tougher choices.
Absolutely. They're prioritizing rent and groceries over remodeling the bathroom. The pressure of just core living costs is forcing trade-offs, and those big discretionary projects are the first thing to get cut.
Which makes the company's big strategic pivot.
Well, it makes it absolutely essential. And that takes us to their long-term plan, focusing on the pro customer.
This is their definitive answer to the slowdown. They see capturing a bigger share of the professional's wallet as their single greatest opportunity, and the market is enormous.
What's the estimate? Something
Around $475 billion a year. And right now, while pros are about half their business, most of that is small, cash and carry type purchases, a contractor running in for some fittings or a couple of tools.
They aren't getting the big orders, the scheduled deliveries for an entire construction job. Exactly. They aren't yet the go-to for what they call the complex pro.
So how are they trying to change that? How do they re-engineer the business for that customer?
They're building out what they call wholesaler-like capabilities,
Right.
and this is a totally different infrastructure from retail. We're talking about dedicated B2B sales teams, special trade credit lines, and really sophisticated logistics for staged job site deliveries.
And this whole strategy really leans on their recent acquisitions, right?
Yep.
Companies like GMS and SRS.
Oh, they're absolutely critical because these acquisitions let them offer specialized products that a normal retail store just can't stock efficiently. GMS, for example, they distribute drywall, steel framing, insulation,
Heavy-duty stuff for big projects.
the materials you need for large-scale construction. So by integrating these wholesale platforms, they're transforming themselves from just a store into a full project partner who can control the whole material pipeline.
That sounds like it needs some serious tech to back it up. What are they offering to lure a pro away from their longtime regional distributor?
The tech is actually pretty compelling. They launched a new project planning tool for creating material lists and tracking deliveries. But the real game changer is something called blueprint takeoffs.
Okay, what's that?
It uses AI and their own algorithms to instantly create an accurate list of all the materials you need right from an architectural blueprint.
I can imagine that process used to be incredibly manual.
Whoa, a massive time sink. It could take a contractor weeks to do that by hand, which slows down their entire bidding process.
So by automating that, they can bid on more jobs faster.
Faster, with more accuracy and less waste. It's a tool that can make them indispensable to a contractor right from the very beginning of a project. It builds incredible loyalty.
Now, you mentioned those wholesale platforms, GMS and SRS, earlier when we talked about the margin pressure. These acquisitions are, they're bringing their corporate margin profile down, aren't they?
That's correct. This pivot comes with a structural financial cost right up front. Wholesale is a high-volume, lower-margin business compared to retail. So bringing in SRS and GMS is a deliberate dilution. It hits their gross margin by about 120 basis points.
So why would investors be okay with that, with a structural drop in profitability?
Because the long-term payoff is scale and market domination. The goal is to grab a huge piece of that $475 billion pro market. They believe the massive sales growth will far outweigh the margin compression.
It's a long game.
It's a long game built on cross-selling. They can pass a big roofing sale from the wholesale side over to the retail side to sell the accessories and tools. They're trading a higher margin on a smaller pie for what they hope is more total profit on a much, much larger pie.
It sounds like a powerful strategy, but pivoting so hard to the pro customer must create some friction elsewhere. Let's talk about the other side of this, the costs.
You definitely see that friction in the consumer experience data. Foot traffic was down 4.2% year over year in the first part of 2025. So while the pro sales are holding up because they're buying high-value items, it seems like the regular DIY customer, the one making smaller, frequent purchases, they're struggling or just not coming in.
And is that maybe related to the experience in the store itself?
It could be. I mean, there's a definite shift towards self-checkout, trying to optimize for speed for that pro who just wants to get in and get out.
Right.
But if you're a casual DIYer trying to figure out which plumbing part you need and you can't find someone to help you, that can be a huge deterrent. You wonder if they're optimizing for today's pro at the expense of tomorrow's core customer.
And what about internally? We've seen some reports about employee skepticism.
Yes. Employee sentiment often flags concerns about just operational quality. You hear associates talk about rising product damage, more theft, what they call shrink, and, frustration that profits are going to stock buybacks while they're facing low pay or reduced hours.
That internal pressure cooker, that's a real risk to service quality over the long term.
It is. It's critical for keeping both customer bases happy. So there's this powerful conflict, right? The company is succeeding at the high-level financial game.
The acquisitions, shareholder value.
Exactly. But they're struggling with the human capital costs on the ground.
Let's end on a more positive note, though, a structural one. Once this current uncertainty passes, what does long-term demand look like?
Well, the optimistic case is built on one simple reality: necessity. The housing stock in America is older than it has ever been.
Right.
And all these years of deferred renovations have created this massive, quiet buildup of latent demand. Some analyses suggest there's a cumulative $50 billion underspend in normal repair activity just sitting there, waiting in the pipeline.
50 billion. That is a staggering number. It almost suggests that American homes are in a state of, managed decay. Eventually, the house itself is going to demand that money be spent, regardless of interest rates.
Exactly. And the retailers preparing for that, they're trying to capture the next generation. They have these new creator programs designed to engage Gen Z as they start renting and eventually owning homes, trying to build that brand loyalty early.
So if we synthesize all of this really complex picture, what does it tell us about the economy right now?
I think it leaves us in a period of really intense structural tension. On one hand, the retailer is executing a brilliant, necessary long-term strategy. They're growing revenue, grabbing market share with smart acquisitions, and focusing on the high-value pro.
That part is working.
Undeniably. But the core traditional business, the middle-class DIY consumer, is clearly stuck. And that reveals the acute financial pressure on the American middle class from high costs and the frozen housing market.
It's a fascinating standoff between that strategic ambition and the current consumer reality. Which brings us to our final provocative thought for you to think about. Given that massive long-term backlog of necessary home repairs, combined with the lowest rate of housing turnover in 40 years, what do you think will break first? The consumer's financial uncertainty or the aging infrastructure of the American home? And don't forget, you can sponsor this podcast for just $25. Your message will be featured across major platforms like Apple Podcasts, Amazon Music, Spotify, and more. If you're interested, contact info at vpod.ai to get started today. Thank you for sharing all your insights, and thank you for listening. We'll be back with our next conversation very soon.